I've approached investing from different methods, and having made lots of stupid mistakes, I've gradually figured out, try to eliminate the mistakes, and I still make them, but try to make less of them. And I found the one thing for me at least, and there are a lot of successful approaches that works in investing, is to find business models that consistently generate cash, that can generate cash even in the most adverse of economic environments, and um, and generate lots of cash relative to the value of the business. Another insight I've gleaned from the School of Hard Knocks is that I'm a very balance sheet oriented investor. Because I'm investing generally in the smaller or micro cap area, though I do have some larger companies. I'm very, very focused on companies that don't have any debt or have big piles of excess cash. I think it takes tremendous risk out of the capital structure, particularly for the smaller micro cap type companies if you're going to go through another 2008. So I try to, some other investors have said out there, you hope for the best, but assume the worst. And it's, my approach has, as a result, become, sort of very defensive over time. I mean, I'm investing, but I'm kind of keeping one hand up to protect ourselves. In terms of, and so my definition of free cash flow is literally cash that's coming onto the balance sheet. So probably cash from ops less maintenance capex, with a clear understanding of how working capital factors in there, and that there's a sustainable consideration of how we're evaluating that. So I'm literally looking for the cash to come onto the balance sheet of these companies and drive up the value of the company, particularly with the smaller, less followed companies. I've found that if they tend to start piling up cash, or the management teams do good things with the cash, buy stock back, pay off all their debt, do highly accretive acquisitions, the market will eventually pay attention. I'm generally, typically, I'm looking for sort of a mid-teens or higher unlevered free cash flow yield on the enterprise that I think is sustainable. And that means I need a business model that is very, very reliable, even in very difficult economic circumstances. And I care less about how fast the cash flow is growing necessarily, though I love it to grow. I'm more focused on the fact that it's going to come in year after year, and the excess cash will come into the enterprise value and have an impact on the market's valuation of the business. And, a lot of times what happens, 3 times last year, I had companies get bought out. A private equity player or strategic sees they can borrow money in such low rates, and the types of businesses I'm investing in can be purchased on a highly accretive basis. That's when you have the Treasury at 2 or 3%, and a truly reliable free cash flow yield in the mid-teens, if our analysis is correct, and it's not always, but we try to do good analysis. That's a potential catalyst for something good to happen.
When you say 15%, do you need that to be a current free cash flow yield, or are you willing to look at situations where perhaps that's your estimate of a normalized yield, but the current FCF yield is compressed?
That's a great question, because that's where I differ from some other people. I really, again, I've been, hitting the back of the head with a 2x4 so many times that I've learned I really prefer the cash to be coming in today, now, latest 12 months. If the management has a good story as to why it's going to improve, or that's wonderful, but I really want the cash to have come in. I really want to buy a bond that is generating cash today, because that cash in my opinion, if I do the analysis of the business capability of generating it sustainably, that's going to protect my investment, and it's going to likely to keep the stock price at least flat and push it up over time. Not that I won't listen to a situation that, but I find, in my opinion at least, a lot of really, really smart and great investors sometimes get enamored of complicated investment opportunities that are very smart and elegantly thought out. But to me, the fewer moving parts that the investment thesis has, the simpler the investment thesis, the fewer things that have to happen for my investment thesis to work, that's the better investment to me. I don't want a complicated investment generally.